Hello, welcome back to Onset Talks with Andrew Kuhn and Geoff Gannon. Thank you so much for being a subscriber to the app. We greatly appreciate it. If you have not downloaded the app on your iOS device or Android, make sure you do that. It's a lot better than going to an HTML webpage. So definitely make sure you do that. So we've been talking a lot about banks on the podcast recently, and somebody asked us about why have you always, and he, kind of, I don't know if you've ever like publicly verified this, but he did it. He's right. Why have you usually, I guess, focused in on like one or two banks as opposed to buying a basket, and how banks are black boxes and, there's inherent risks in there sometimes. Why have you always done that?
I think that's the best way to buy banks. Because two, I think there's very different, if you pick the right bank, just as if you pick the right insurer, the right people running it, I think you'll have really good long-term compounding returns. Whereas I think the average bank is a bad business. I think the average insurer is a bad business. It doesn't have much in the way of advantages, and it won't be particularly well run by people and stuff like that. So you could buy it to get a flip from it over a period of years because like it's particularly cheap or something. Like when you were talking in the rundown with Vetley, he was talking how cheap European banks are. I could buy a basket of European banks just because I think they're very cheap. But I would need to find something that I think is a good compounder. And I think the results can be very, very different depending on which bank you're in. So that's why I would do that. About like them being a black box, I don't know. Giant banks, yeah, they are black box. They're often really 4 or 5 completely different kinds of business units in them. But smaller banks, I think, are not necessarily the case that they're a black box. And you get an idea of what kinds of loans they make. You can read the call reports, get a real feel for management over a long period of time, stuff like that. Yeah.
Would the Fed not allowing big banks to buy back their stock, would that make you reluctant to ever invest in a larger bank because there is that sort of big brother aspect to it?
No.
Like I'm sure Buffett wishes he could invest in banks under 100 million or 200 million. Or 500 million.
Yeah.
All the way down.
Right. No, I wouldn't. But yeah, they do have an issue because they can't get too big and they really don't have much choice other than to buy back stock and pay dividends. So temporarily they do have this problem. That's absolutely true, that they could get overcapitalized. So of course they might not right now because like it's just demand for loans and stuff could be high for a little while. So far we have like no data on that, but like the initial government programs and the initial COVID stuff and stuff certainly grew the bank's balance sheets, but I don't know if that'll keep happening. So I just like them less because I think they're less focused on the very best businesses usually. There's nothing wrong with them, and some of them are very cheap. And some of them have great deposit bases, Bank of America being the best example of that, and Buffett owns that. But do I think Bank of America will compound at the rates that some smaller banks that you'd find would? Like the best, do I think the best of the big banks will compound at the kind of rates that the best of the small banks will? No. And I don't think it's because of government regulation and stuff like that. I just think it's issues of size, and they just can't fit into niches at all. They kind of have to. There's just nothing that they can do that way. They can't be as focused.
Have you ever seen any studies on investing in a basket of banks under, let's say, 500 million and that are trading less than book value and maybe a return of equity of like 10+%? I wonder how that would do.
No, I haven't seen that. And that is a good question. So there's lots of things that you can find, bank data that shows you like what the average is for different size groups, like what the average efficiency ratio is, average return on assets, return on equity. It would seem logical that you could like narrow your world down to those that are a bit better performing than average and a bit cheaper than average, both of those things. But there's so many of them that's probably possible to do. But no, most of the things I've seen about that are focused on like value type approaches to it. I haven't seen, like we've said this before, I haven't seen a lot of things focused on finding quality, really small banks and things like that, which is interesting because like growth companies, I feel like if they have an idea that's unique, people are really focused on them. Mm-hmm. But I do feel that in general, like banks and insurers, when they're small and growing or like having success or whatever, people aren't really focused on like, do they have a better model? What, like, are they have a long runway for growth? Whatever. It's more like, are they cheap and things like that? Than you would if, like, say you had a brand that was, small or whatever. Yeah.
Got it. Cool. Well, thank you so much for being a subscriber. Make sure you email me your questions, focuscompounding@gmail.com. If you could, do not DM me your questions because I get a lot for like the podcast and I don't want to let it get lost in the shuffle. So focuscompounding@gmail.com. Thank you so much for being a subscriber. Thank you so much for all the support, and we will see you in the next video.